What's up, guys? In today's video, I'm going to show you guys how to safely leverage your crypto. No, this is not leverage trading, but this is going to show you guys how to reach maximum capital efficiency so you can maximize your gains to the upside, as well as maximize your airdrop potential and maximize your gains on these different altcoins while still having exposure to the upside of Bitcoin and ETH. But first off, if you guys are new to the channel, this is Drake on Digital. I talk all things crypto, DeFi, NFTs, altcoins, you name it. If this is your cup of tea, drop a like, subscribe to the channel, and if you guys are a wisdom one-liner holder, drop it in the comments below and tell me which number you are holding, and I'll be doing a giveaway in the next video. If you guys want to grab one, I got a link in the description below so you guys can mint a Wisdom One-Liner NFT. Let's go and get into this. So the first things first is choosing your asset and choosing the chain. This is going to be somewhat of a beginner-friendly video, so if you have no idea what DeFi is or how to even leverage or use your crypto as collateral, this will be the video for you. If you're a altcoin degenerate and you are trying to get the next 100x gem type of thing, this probably isn't the video to watch. However, this is going to be your video that allows you to be more capital efficient, and this is one of my favorite strategies to maximize the efficiency of my capital. First things first is choosing your asset in the chain. I like to use Base, but you can also use Arbitrum, Optimism. Notice how I'm choosing some of the layer 2s. That's because worst case scenario, they at least roll back to ETH, so it's just less risk. What I'm trying to calculate and protect against is going to be unforeseen risks that I cannot calculate. One, for example, is bridges. I learned back in 2021 when I was playing around on Phantom and I had some Ethereum over there. I was exposed to the multi-chain hack. I did not know that would kill me, and it obviously didn't kill me, but it did a big hampering on the bags, but it taught me a very valuable lesson. It's the cost of crypto college or crypto tuition, and I'm sharing it with you guys so you guys don't make the costly mistake I made. So that's why I'm choosing one of the ETH L2s. Now, you have Base, you have Arbitrum, you have Optimism, you have Mantle, you have a couple of other of the layer 2s. The reason why I've selected Base is me personally, I speculate and I think that there is going to be an airdrop. So using the Base chain is going to be one of those ways. And the borrow rates are relatively low. I'm going to be using Aave for this example. These rates are a little bit higher than some of the other DeFi platforms, but the reason why I'm choosing Aave is because it's a safer protocol to use. It's been around for a while. It's got a lot of TVL locked up and it's stood the test of time. Several of the other protocols, sometimes they'll get rugged, hacked, exploits, and the worst thing you can do is put your funds at risk. So we're going to be using Aave for this example. Now, next is to choose your asset. You have Wrap Stake ETH, Coinbase, you have USDC Coin, you have ETH, and other stable coins. Me personally, I'm bullish on crypto long term, so my exposure is going to be in some form of ETH and derivative. Now, me personally, I would say to go with ETH because it's more capital efficient, but you don't get that staking yield. I'm using Aave for this example. I am using other protocols as well to maximize capital efficiency, and they're kind of like paying me to borrow. And obviously, it's not with the full bag. This is just a little bit so you can maximize capital efficiency. But for this example, we're going to use Aave because it's relatively simple and easy to use. So as you can see here on Aave, we have a max LTV of 80%. What this means is if I lend out $100, the most I can borrow is $800. Or I'm sorry, not $100. If I lend out $1,000 worth of ETH, the most I can borrow is $800. What that means is basically $200 is just kind of being vaporized and not really even put to maximum capital efficiency, which is okay because normally I'm bullish on ETH long term and I think it's going to do well. So I'm happy just simply holding it and having exposure to ETH. So what I would do is I would simply supply some ETH here. Now, there are some other things you need to keep in mind. There is a liquidation penalty and a liquidation threshold, which we'll get into later. Obviously, when you're lending out tokens, you do not want to borrow to the max. If you do this, you are just setting yourself up for failure, like to get absolutely roasted and liquidated and lose your money. Don't do that. It's not cool. But we're going to go ahead and supply some ETH. So switch to base. We'll go ahead and supply 1 Ethereum just for even sakes, or even Z, whatever you want to call it. So we're going to supply 1 ETH, and we're going to go ahead and confirm this transaction. This will go ahead and give us a health factor in what we need to look for, but we are going to hit sign, create, confirm, and boom. Gas fees are so much lower on base. Normally they were a couple dollars, or not a couple dollars, but several pennies. But now what we can do is we can borrow some more ETH and loop if we want to, but we aren't going to do this strategy. We are practicing capital efficiency so we can speculate on meme coins. You didn't hear that part. So we have some ETH lent out here. If we go to our dashboard, you can see here we have a health ratio of nowhere because we aren't borrowing anything. So we're basically 100% right now. Now this is where the games get fun. We can choose to borrow some USDBC. This is going to be 8%. This is relatively high for some of the other protocols. The best place to go to check what the going rates are, or the best ones to look for, are going to be on ETH. Like the Go stablecoin is around 5%. You can actually borrow some stablecoins for like 0.5%. I'm not trying to confuse you in this video, but I'll show you an example at the end so you can at least see what I'm talking about. But let's go back to base. So we lent out 1 ETH. Now let's go and borrow some stables. So I'm going to borrow some, actually that's, wow, it just jumped randomly. Yeah, it's because there's not a lot of liquidity here. So let's just go ahead and borrow 200 just for this example. You see here I have a health factor of 15 if I do 200. If I do 2,000, it's 1.58. Notice how it's getting in the orange. Orange is kind of like, whoa there, Tiger. Take it easy. Think about this. If you want to do it, okay, just manage your position. However, when you get to something that's in the red, like this, it's like, whoa, easy there, Tiger. You're about to get absolutely roasted. Once this hits below 1, you're liquidated. You lose your ETH, your collateral. That's over there. It's like gone. You lose it. However, you do still have the stable coins you borrow. So current prices, ETH is like 3,800. So these stable coins that are borrowed right here, $3,000. I'll have these in my wallet. So at least I'll have $3,000, but I will lose my ETH. Now there is on Aave, I believe there is a partial liquidation. Let me go ahead and take a look. So on Aave, you have a 5% liquidation penalty. So you will technically get some of this ETH back in your wallet. You won't get all of it, but you'll get like a tiny percent of it. TLDR is just don't get liquidated, man. Like just don't. So manage the position accordingly. There is such thing as like cascading wicks, so be careful with that. But for this example, we borrow some ETH. So let's say we do 500, or borrow some stables. Let's say, for example, we borrow 500 in USDC. So at 6.32, like we're super healthy, dude. Like the only time we would get liquidated is if ETH literally crashes to like $700. Yeah, there's a chance that happens, but is it likely? It's very highly unlikely. So at this position, we would be extremely safe. So I would be comfortable taking these $500, playing around, doing whatever I want. This loan needs to be repaid though. So that money is not free. It doesn't come out from anywhere. So if I want to get my Ethereum back over here, I need to repay this loan. But here are my risk details. Right now, since I am earning a yield paid in ETH, it's 0.71%, I'm technically only paying 1.67% APY. You're probably like, wait, it's 16% over here. How are you only paying 1.6? Well, it's because I have $3,800 in value earning me 0.71%. And I'm only paying 16% on 500. So we'll just call it 4,000. That goes into it 8 times. So 8 times 1.67 is about 16.47. That's how you calculate that. But if you don't even know what I just said, that's okay. You don't need to worry about it. But we have a 6.32 risk factor. We check these risk details out. This explains it all to you so you guys can see what's up. Your goal is don't reach 1. You reach 1, you're roasted. Actually, at 1, you're okay. At 0.99, you're roasted. You lose it, don't do that. But we now have maximum capital efficiency because we have exposure to ETH. So we're effectively shorting the stablecoin. Let me repay this so I'm not just like paying money for no reason. Because yeah, that's what I do for these YouTube videos. But effectively in this position, we are shorting the actual stablecoin. And we are longing ETH because we still have exposure to ETH. which is something that we want to do, especially if you are along the crypto market. Now, notice how I repaid my full loan, but yet there is a little bit of dust in here. That's because of that tiny amount of yield that accrued. I just repaid it. It'll show up eventually. The UI's got to refresh. But effectively, in a position when I'm borrowing stables, I'm long ETH and I'm short the stable coin. So at some point in time, I will need to repay this USDBC in order to free up my ETH. And if I just simply sit it here, eventually, if this APY gets really high, I'm going to lose my money. Like, as in, eventually it will climb really high with the interest rates, especially at 16%. That's pretty juicy. That basically means if I'm borrowing $1,000 at the end of the year, I owe $1,160. And then that compounds from there. So something to keep in mind. But going back to this capital efficiency thing, I have exposure to ETH. I'm bullish on ETH. I think it's going to do well long term. So I still have my ETH bag increasing in price as ETH goes up. Now it can also decrease in price, but I'm bullish. Like I'm kind of a perma-bull long term on Ethereum and Bitcoin. So I think it's going to do well. The reason why I'm not lending out Bitcoin on here is, one, it's wrapped Bitcoin isn't an option. But if you go on Arbitrum or Optimism, you actually do have wrapped Bitcoin as a option, and you can lend this out here. Now, you can choose to do this, but you do take on additional risks. You have the risk of BitGo, which is a centralized company, them going bust, as we saw how that went with Celsius and with FTX and their Bitcoin version that basically went to like zero. So if you had your Bitcoin in that version, you're absolutely roasted. So that's also why I'm choosing ETH. ETH is the native asset that is not on Ethereum, but it is native to Arbitrum, Base, Optimism, Ethereum. These are L2s, so they roll back to the chain. So theoretically, it's native. Now, second is effectively with this strategy, I'm kind of longing ETH because I can choose to loop and buy more ETH and deposit into here and keep doing it. That is really risky though, because you're basically taking a leverage long. But I can take these stable coins and buy different meme coins. And if those meme coins go to zero, at least I still have exposure to my ETH or exposure to some of the other alts. Keep in mind, again, this loan will need to be repaid. So do not be super degenerate with it. For me, how I play it is I have some cash in the bank. That way, if I do need to repay the loan and alts that I'm bullish on, I think are going to do well, I can still keep exposure to them. And I just bring cash in the bank onto the system, and then I can use that to repay my loan. If I need to, worst case, it gets like out of whack and the health factor is roasted. Or you can simply just pony up more ETH into this and you can raise your health factor. That's entirely up to you what you want to do. There are also other strategies you can practice out of this. I'm not going to get into more complex strategies like borrowing different altcoins and LPing with them, but this is a simple strategy that you can use for capital efficiency. Now, also notice why I wasn't really going into CB ETH and wrapped stake ETH. Yes, these do automatically have like a 3 or 4% yield in ETH, which is good, but if you are trying to get maximum capital efficiency, this isn't the way to go. These ones only have 71%, whereas ETH is 80%. So it's 9% better. But it's still something. And CB ETH or Coinbase ETH is only 67%. So you're missing out on a percentage, and there's a chance that you get liquidated if you get it too close to that one number. And they also have peg risk. So when you are holding wrapped stake ETH or Coinbase ETH, there's a chance that those tokens depeg. Like we saw with STETH last bull run, that depegged and it wasn't at the price what it was supposed to be based on the underlying ETH asset. So there's just additional risks involved. That's why I choose to just stick with native ETH. And it still has a yield, which is good. And depending on the other protocols you use, you also get a yield with them. Now, why do you do this? Well, first, just simply holding stablecoins is risky. Like, you do not want to hold a stablecoin. When you are holding a stablecoin, your maximum upside is 1. Like, it doesn't go above peg. That's what a stablecoin is. Your maximum downside, however, is 0. You lose entirely everything, which isn't good. Like, nobody wants to do that. So that's why I say ETH and Bitcoin, those are the assets that you use and you borrow against those. You can use that to borrow some stables, but do not go nuts and ham crazy. You want to be able to manage that loan and be able to repay it. So you need to have cash in the bank, or you need to have some other assets that you can pony up to keep that from being liquidated. You do not want to practice this strategy if you're a newbie and you've never messed with this stuff, because you can lose everything. So be extremely careful with this. Remember the risks as well. You have smart contract risks with Aave. You have bridge risks, which we've mitigated by using a ETH layer 2. And then you also have DPEG risk, which we've also mitigated by using Ethereum itself. So we've basically labeled it or minimized it down to just smart contract risk and exploits with the Aave protocol itself. But we are helping with that by being able to borrow against it. So worst case scenario, if this does get roasted, we don't lose all of our money. We at least still have that capital that we borrowed. But again, this is a risky strategy. This is something that you can use to have maximum capital efficiency. And before we close out the video, there are a bunch of customized strategies that you guys can get into this. If you guys want to see those different types of strategies, you can check out some of my older videos. You can also see what I'm farming and doing in the markets by checking out the exclusive Discord. That will be in the description below. But let me show you the last protocol before we close out. I also share some DeFi strategies on there. Obviously, it's a little more advanced. So if you're a beginner, highly recommend you guys check out YouTube and kind of go through the School of Hard Knocks there before you even join the Discord. Discord is going to be a bit more advanced. So if you're a newbie, try to do your school of YouTube first. Before we go over to Ethos Reserve, let me go ahead and show you guys. You can simply just withdraw your collateral after you repay your loan. So I'm just taking it all out and withdrawing it. But you can see here, I do have a little bit. So, I mean, my health factor is 1.09. It's going to get absolutely roasted. I'm sorry, ETH. Maybe we'll come back to you in like 10 years and it'll be worth something, or this debt will be like just roasted. But yeah, you can see here, you can withdraw. I repaid my loan. I'm happy, whatever. But if I go over to Ethos Reserve and I simply go to these positions, I can actually open a vault with this, and it's only going to charge me 0.5%. So if I go to this vault here and I do get started, I can choose whichever token that I want. So you can choose wrap stake ETH, or you can choose ETH. Now you want to factor in, again, the collateral ratio. Like this is wrap stake ETH, 110% is actually pretty good. The minimum or the critical ratio, this is probably something you want to keep in mind because you have partial liquidations with this platform, but is 135%. There are different smart contract risks involved with this. So if you're taking this on, just keep that in mind. But like if I choose to deposit in here, it's 108 and 120. I can deposit into here and deposit my ETH and borrow at a 0.5% interest rate. Actually, it used to be 0.5%. It's 2.25%, which is a lot more expensive now. But you pay a one-time fee. So instead of paying the fee of 17% per year, this does fluctuate. Like it'll change. I'll show you what it looks like. You actually have like a cool little chart. Average is 14%. Sometimes it goes low, like 6%. Sometimes it goes high, like 42%. But on average, it's lower. So if we go over to Ethos Reserve, if I was to borrow against this or lend out some ETH, I can borrow some of the ERN token. The ERN is technically considered their USDC or their stablecoin. If we take a look at their stablecoin right now, it's not so stable. So technically you're actually paying a little more to borrow this because you're paying that 2.25% and you are taking this haircut if you sell for it. But you don't have that consistent 6%, 7%, 6%, or that 16% at random times. Sometimes it spikes to 100%. I mean, sure, it's only like a day or two. And obviously, if you don't want to pay that, you can repay it. But something to keep in mind with that. Like, you don't have an ongoing interest rate on this. This is just a one-time fee, and that's all you pay. On some chains, you can also opt in to do like variable or stable interest rates. The variable is going to change over time, but if you do like a stable one, depending on which chain you are on, it'll actually stay a certain interest rate. It is going to be a little bit higher, but on some chains and some protocols, you are able to do that. So do keep that in mind with this at least. But Going back to Ethos Reserve, you can borrow and then do what you want with the stables. Eventually, you will need to repay your loan to get your collateral back, but those are different things that you guys can look at. Now, this is also one other thing I do want to point out that I really like about this strategy is if you do have a depeg situation like this, where you have the ERN stablecoin going down, or even like USDC or DAI depegging, you can actually get them at a cheaper rate and repay your debt at a lower cost than you normally would have. So that's also why I do like this strategy and having capital outside of the crypto ecosystem, because it allows me to take advantage of the upside of ETH and Bitcoin, as well as having advantage of speculating and purchasing other altcoins or meme coins and playing around in that ecosystem. And it keeps me from losing my ETH position. I've seen a lot of times people are like, yeah, I sold my ETH for a meme coin or some altcoin and it absolutely underperformed and went to zero, and I just wish I had my ETH. Well, this strategy, if that does happen, you still have your ETH, and your meme coin, even though it goes to zero, you still have your ETH and you're happy. But that's how you practice capital efficiency and use it to the max, and how you can play a safe leverage position in crypto. Thanks for tuning in, guys. I hope you guys enjoyed this video. If you guys did, drop a like, subscribe to the channel. Tell me what you guys think of the video. And if you guys want to join the exclusive Discord, there's a link in the description below. You guys can join that there to see how I'm playing them in the markets and what I'm doing. Let's go ahead and hit you guys with Proverbs chapter 18, verses 10. The name of the Lord is a fortified tower. The righteous run to it and are safe. He is there for us at all times. Thanks for tuning in, guys. You guys can also access the free airdrop sheet in the description below, and we'll see you guys in the next one. Peace. Now, some other things that this does allow you to do when you have these stable coins is it allows you to participate in all these different dexes and these different protocols. You can now put your stable coins to work, whereas normally if you had some ETH and Bitcoin, you were kind of strapped to either holding ETH and Bitcoin or selling. You can now get some stable coins and use them on these different protocols and farm some airdrops. This sheet is in the description below, so you guys can access the free version. I have the full version that is accessed for the Discord group. It has the airdrops to claim, tokens to hold, NFTs, nodes to set up, airdrop tokens, meme coin lists, airdrops to currently claim. It's a full list of everything. But this is the free version that you guys will have access to. It's entirely free. You can now put your stablecoins to work and play around with all these different protocols. This allows you to have exposure to ETH, have exposure to these different protocols or some of the altcoins you want to play with, and get some airdrops. That is how you maximize your capital efficiency. Hope you guys enjoyed the vid. Peace.